watching Stockwatch. I'm Simon Brown. Joining me to unpack your stock-related questions today, Alex Duys from Umthombo Wealth, Chantal, Marx from FNB Wealth and Investments. Be sure to send questions via email, stockwatch@bdtv.co.za, SMS 41392, or on Twitter at BusinessDayTV using hashtag Stockwatch. Alex, Chantal, appreciate the time. Alex, let's start with you. Let's start with trade deals. US and China have got some sort of peace in our time. US tariffs to China will get a 10% tariff. Chinese tariffs to the US at 30%. This for 90 days. Very much, I think, what the market was looking for. US futures are looking very positive on it. It is, I suppose, a climb down, and it's what we needed, because at the plus 100% tariffs, there wasn't going to be trade.
Yeah, certainly, Simon. Especially after the shenanigans of April. It's good to see some form of sanity returning to the market, as well as decision-making from the Trump administration. So let's see what happens here. So that this buys us some more time, I guess, to iron out some aspects of a potential trade deal. We've also seen, of course, developments on the UK last week as well. So certainly seems to be moving in the right direction. At the same time, there's potential further negotiations on the Ukraine, Russia as well, and also the situation in India hasn't flamed up further. So a bit more risk on at the moment, slightly better. And as a result, you're seeing, for example, gold pulling back and equity markets being quite strong, specifically after the lows we had in early April.
Chantal, I mean, Alex's point is that we don't know where it's all going to end up, but what we probably do know is those Liberation Day tariffs from 2nd of April are undoubtedly the high watermark, and we're probably going to get numbers below it. And there might still be tariffs, they might still be nasty, but it is not as bad as it was on that 2nd of April.
Yes, absolutely. I think that this was a meaningful de-escalation, and the fact that the US is willing to sit around the table with China, pointing towards further positive developments on that part, and perhaps a more nuanced approach to that trade deal, and by extension, other trade deals that are going to be made over the next few months. I think what we cannot take away from April 2nd, Liberation Day, is how chaotic it was, and how arbitrary the policy change was seemingly arbitrary the policy change was. And I'm just a little bit concerned that policy uncertainty will remain the order of the day in the US. It's been tariffs, but I mean, what's next?
Absolutely. And now we've got two 90-day rolling windows. And I think you're right. We want certainty. We might not like what we have, but certainty is nice. At the moment, we don't really perhaps have that. So let's move to something that was some certainty. Chantal, Box's first set of results as a listed company. What stood out for me, and there was a lot in them, 5.5% trading margin. That's a ShopRite trading margin. Your take on the numbers and the share at its current share price, which is around 68?
Yes, so I think that the share is more or less fairly valued. So I'll start with that. And that probably explains why we saw a negative market reaction to what was otherwise a very solid set of results. The market would have been aware of the changes in the number of shares in issue prior to this announcement. So I don't see that as the reason why the share was under pressure. Perhaps just some profit taking after a reasonably strong run post-listing, and the share basically being fairly valued. But the result overall was really strong. Very positive top-line momentum, positive trading momentum. And as you mentioned, the highlight was that trading margin at 5.5%. I'm not sure how sustainable that is, but for now, it's exceeding management's expectations. So I wouldn't be surprised if we see a slight step down there in future, and that could also explain the negative market reaction.
Alex, your take on the Boxer results? As I said, maiden results. We knew a lot about it. The extra shares, for example, is their value? It's actually lower. It's now sub 66, down a bit today. Your take on Boxer?
Yeah, so we do like the Boxer investment case, especially if you take a 3-year plus view. So I think important to note for investors that perhaps are more short-term orientated, you will probably see revenue growth of, call it 10% plus over the next 3 years. But with margins coming down and finance costs and so forth, you're going to see earnings number probably being mid-single digits. And that might disappoint some investors. But if you're willing to hold longer on, I think you will eventually start getting operational leverage, meaning earnings will grow faster than revenue. But we are in that period now where it's not going to be the case. And they're investing, for example, in DCs, and it's going to take time to get capacity in there. At the moment, the lease liabilities is eating into the cost base. You have to invest in employees. So they're all investing for the future, which means good for long term. But perhaps not that great result in the short term. So just be cognizant of that. But we certainly do believe in the longer-term investment case. And I think this set of results has shown us they're still on the right track.
And Alex, is the route just a pure play on Boxer or Pick and Pay? A lot of folks say Pick and Pay because you get the Boxer essentially at a discount, albeit the risk of Pick and Pay. Or do you prefer straight into Boxer?
Look, when you want to buy a compounding business that you want to hold long term, it's always better to get direct exposure. Okay. So think of same as, for example, like a Capitec or Clicks. You want to buy it directly. I think Capitec was a good example. In the past, you could have bought it via PSG, but it's probably just better to buy it by itself.
Yeah, and your return was way better through the direct with Capitec, absolutely. Chantal, Tiger Brands, and I got to say, I know the new CEO came in with lots of promise and turnarounds, and I mean, they usually do, but we're seeing delivery here. We had a trading update, 15 to 25% higher on HEPS, continuing HEPS 30 to 40. Tiger Brands, I mean, it's run hard. Is there still something left here, or is it kind of like all already in the price? It's now, up at 312?
Yeah, it certainly was a very impressive trading update. I mean, not a lot of detail provided, but just the bottom line guidance that we did get was really strong. And the fact that they pointed specifically towards volume gains, which we know from Tiger Brands' experience over the last few years has been very, very difficult to come by. So I think that they're staying invested in the businesses that are actually growing and where they see a solid future. They're divesting from the rest that's perhaps also been a drag on volumes and margins. And even within the brands that they're keeping, they're really narrowing in on the product set that they're putting out there. So I quite like the story. I think that the proof is in this trading statement right now. We'll obviously get more details in the full set of results. But in terms of whether or not it's a buy at these levels, I'm not 100% convinced. It's re-rated quite nicely. I think it's trading on a forward P of about 14.5 times now. That's relative to a long-term average, let's say 5-year average of about 12 times. I think for a food producer, that's more or less fair. So it depends. I mean, if they are able to actually continue on this kind of growth rate of the next 3 years, then it would be an excellent opportunity still to get involved. But yeah, we'll have to wait for the full results to actually see what the probability of that would be.
Alex, your take on the trading update? Chantal says, I mean, not a lot of detail. It's just a trading update. It was a good trading update. Stock has certainly run a bunch. Would you be looking at Tiger Brands at these levels?
Yes, we still like it. So they've obviously reduced complexity, which is important. They are focusing on efficiencies. And then the next phase will be capital allocation. We're probably going to see further divestments as well as potential share buybacks or better dividends going forward. So I think these aspects makes Tiger Brands still quite a compelling investment case. I agree with Chantal, it's not as cheap as it was, and perhaps difficult to allocate new capital. But I think if the theme plays out, you can probably still buy it, but the returns will not be as good as we've seen over the last, call it 6 to 12 months.
Okay, yeah. Question coming through. I hold some Berkshire Hathaway shares. Should I be worried about Warren Buffett exiting? And then a follow-up. I hold the B shares, not the A shares, and I'm just checking because the A shares are 771,000 each, and the B shares are $530. Alex, I mean, Warren Buffett leaving, I suppose we all knew it was happening. The man is 94 years old. He's still going to be chair. Would you be worried about a position in Berkshire Hathaway with Buffett stepping down as CEO?
I think obviously what Buffett and Munger created is a culture. So, and the new team there is going to take it forward. So unless you see something change there strategically in the way they assess investments and so forth, then perhaps you can revisit that. But for the time being, I will certainly keep it in the bottom drawer.
Chantal, the Berkshire Hathaway, A or Bs, although for most of us it's going to be the B shares, would you hang on?
Yeah, I mean, I think that if you look at what they currently have in their portfolio, it's very much cherry-picked, especially the direct equity investment holdings, and they've got a lot of cash to deploy as well. That cash pile has grown because the Buffett & Co. didn't necessarily see value in the US markets, and they were 100% right on that. The business has a history of outperforming the S&P 500. And I think if you think the US market is still expensive, which we think it is, Berkshire Hathaway is probably a really nice alternative for US exposure rather than buying the S&P 500 directly. So I'd also happily hang on.
Yeah, and they've done that clever deal in Japan where they raise debt in yen so they don't have the currency risk, and then have some very, very nice assets, and the dividends pay down the debt. Classic Berkshire Hathaway. We've got MTN quarterly trading update. Chantal, we've seen the MTN numbers because, of course, we've had Ghana, we've had Nigeria, we've had Rwanda. I want to say one other, but I can't remember. So we get a sense of it. I got to say, I'm not a telco fan, but the stock's done well this year, and that was a good update, I thought.
Yes, so I think that the two main growth areas for MTN is data and fintech, and those are actually growth businesses. They're less utility-like relative to the voice business that we're actually seeing being in structural decline at the moment, for that matter. But there's still a lot of scope for growth in data and fintech, particularly in the rest of Africa. I think where the disappointment from today's update came through was the South African business. Yeah. Competition is very intense in South Africa. So service revenue growth is basically capped because you are in a bit of a price scuffle with your biggest competitors. So yeah, I mean, I think overall it was really strong. The business case for MTN does not hinge on the South African business. It's a really nice kind of core part of the portfolio that'll just keep ticking along with utility-like returns. But the rest I actually still see as growth businesses, particularly in Nigeria.
Yeah, and they're getting price increases through. The Naira stopped falling against the US dollar. Alex, your take on the MTN update and MTN investment case thereof or lack of?
Yeah, so we're not a huge fan of telecoms, similar to you. And I think the case of MTN is the complexity is a big issue for me. Obviously, in multiple jurisdictions, it's got regulatory risks, and we've seen that play out a number of times over the years. Currency risks, so it's very, and of course, extremely high capital requirements. And you don't necessarily get the same returns that you used to get in the past. So that's the negative side. Positive, they do obviously have a fantastic opportunity in fintech, as well as data, specifically in Africa. Remember, fintech predominantly led by the banks, but this is a case where the telecoms actually a big play in Africa. So that is an advantage. You shouldn't undershoot that. But other issues like with Turkcell just doesn't go away. And once again, this adds the complexity and uncertainty for me. So for me, I can understand why stock has done well this year thus far, but doesn't excite me to want to get involved over a medium to long term view.
Yeah, it is up third, I think, so far year to date. Chantal, Baldwin and Calgro M3 came out with results this morning. Both, I think we call them micro caps. They really are proper small. Both in the same space. They build houses. They do it differently. Calgro typically lower cost, sort of sub-million. Calgro looked like the toughest set of numbers. Your take, I'm not sure if you follow either or if you've got a preference for either or neither.
Yeah, so I follow both. My preference is for Calgro. So we've gotten that out of the way. I think when we look at the Calgro numbers specifically, there was an impact on a restatement in their Memorial Parks business in the previous year. So revenue came under a little bit of pressure. Revenue in these businesses tend to be a little bit more lumpy as well, because it depends on how many units you actually put to market in a specific financial year. And because the financial year is very strict in terms of its beginning and its ending, sometimes you can see some discrepancy there. For Baldwin as well, a very kind of lumpy type of number from a housing sales perspective or unit sales perspective. But what was really interesting in that business for me, and that's probably going to make me like Baldwin more over time, is that they've got a growing and very interesting annuities business. Yeah. So in their complexes, they provide solar backup power and Wi-Fi and a whole host of other kind of services that are annuity in nature, which means they're recurring. And that part of the business is growing quite nicely. So yeah, I mean, I think both sets of results weren't great, but as I mentioned, it tends to be quite lumpy, and there are also some good things to take away from that.
Yeah, I also prefer, I like my Calgros, but this Baldwin did maybe you look at it. That annuities now, almost 8% of revenue, 175.8 million. Alex, Baldwin, Calgro M3, neither, both?
Yeah, so look at both. Also got a preference for Calgro. On Baldwin, only one thing I'll add is I can't recall a sustained period of time where they've generated cash. So that's a concern for me. Where at Calgro, they do go through cycles where they generate cash. And they had that over the last 2 or 3 years. They're probably going to go through a cycle now where they're probably not going to do that well from a cash perspective, but at least they are cash in that business. One thing to highlight in the results now is they said that they've got about 600 million of inventory. That is, houses already been built that needs to be sold. So that shows you that it's going to be nice revenue growth and good cash inflow into the business. Then, of course, they've got this enormous opportunity in Bankenveld. So those are the where these, if you sit on Marlborough Gautrain station, and you look at the side where there's no land, that is Balkenveld. That's going to be developed over, call it 10 to 20 years. So that is a big opportunity for them, combined with other opportunities they have. But I just think it's a better run business. They have showed better ability to extract cash over time. And I think the prospects also looks for me better relative to a Goldman.
Yeah, agreed on that. Alex, to stay with you, question coming through. What happened to my Anglo Gold shares today? Huge cash flow increase just on Friday. What did they say? I think 7% increase. Stock off massively today. I suppose, Alex, I mean, we kind of knew that these gold miners are going to be printing cash. We've all seen the gold price. And to your point at the top of the show, if we've got trade peace or tariff peace in our time, perhaps a little less sparkle for gold. Although, I mean, they're still making massive profit, anything above 2,000, never mind 3.
Yes, agreed. So I think today's move has got nothing to do with the results of last week. I mean, that was a very good update from Anglo Gold. And operationally, the prospect still looks good, but the views are all about the gold price and sentiment. And as you allude to beginning of the show, I was showing that, indicating that investment confidence is starting to pick up. And that just means that we have a bit more risk on, and then as a result, people then selling the gold to buy other opportunities. But that could change again tomorrow, next week, we don't know. So if you're still bullish on gold, then I would imagine keep it. But if you do think there will be a normalization in the gold price, then Anglo Gold will remain under pressure for a period of time. Depends on your views.
Depends on your views. Chantal, I mean, gold is volatile. Gold miners leverage to that volatility. That's the nature of the beast. And what we are going to get is we're going to get monster dividends. Hopefully they're not going to go and buy stuff. We're going to get monster dividends coming from them. I suppose it is to Alex's point, if you're still bullish on gold, the gold miners, they're going to pay you to hold them.
Yeah, the problem with the gold miners is that they kind of pre-run what is expected to happen in the gold price going forward. Yeah. So what we've seen today was the gold price coming under pressure because of perceived certainty. Now, whether or not that certainty or that perceived certainty is going to remains up for debate. So you can either start saying that this could be the beginning of a gold downturn, and the gold miners, while they're still printing cash, their share prices will start reflecting lower gold prices way before those gold prices actually start or get to a lower point. And obviously the converse is true as well. I think my strategy from a gold miner's perspective at the moment is to look for opportunities to take some profit off the table, remain invested because uncertainty is still high, but to take some of that profit because most investors would have made a lot of money out of their gold mining shares, but it never lasts forever. And it's very important to maintain that perspective when you're investing in gold miners and gold in general.
Yeah, they're not bottom drawer stocks, and I like your point. They are anticipating a gold price, and it's played out, but now we're on the other side. Chantal, question coming through about Raubex, a couple of them. One is what happened to my Raubex price. The other is how worried should we be? They had a whistleblower report. They were supposed to have results today. They've pulled the results. If you were a Raubex shareholder, maybe you are a Raubex shareholder, how worried would you be about this?
So I am a Raubex shareholder, for disclosure. I've been a very happy Raubex shareholder for a really long time. The reasons I like the company is that they're very much exposed to the South African infrastructure kind of space, specialization, uber specialization in roads and earthworks as well. And in roads specifically, we've seen continued spending actually coming through from Sunrail. So they've been a beneficiary of that, and they'll probably continue to be one, depending on what's in this whistleblower's report. What I took from the announcement on Friday, though, was that it's not going to have an impact on their financial results or the trading statement that they put out. So I'm not sure what exactly this whistleblower report relates to. We really like the management team. We think they're top class guys, and they've never given us reason to doubt what they're doing and the way that they go about doing business. But obviously this puts a question mark on the name, and I think investors will probably remain skittish until we know what exactly was in that report and until the allegation is resolved.
Alex, I suppose one thing to say from what Chantal's saying is that in their defense, I mean, they were completely open about it. They pulled results. They I suppose, doing all the right things. I don't know if you're a Raubex shareholder, what would your response be?
Yes, I think it's important to note that the company is still doing operationally quite well and it's got a good pipeline, so there's no concerns there. Yeah, whistleblower is always very difficult because, it could come to nothing or it could be very serious. We don't know. So there's certainly reason to be concerned, but I won't say you should do any knee-jerk reaction and looking to sell your shares based on that. Obviously, if the information comes out and it is very material, then perhaps you could reconsider your position. But for the time being, remain. I think they are trying to handle it. As you say, they are disclosing it, so let's give them a bit of a doubt for the time being.
Yeah, and to all accounts, and maybe we get proved wrong in time, but I mean, this is not a deep fraud within the company as far as we know, and certainly as far as management has said. Alex, question coming through. What's the best luxury stock out there, either locally or globally? I'm not looking to buy just yet, but I want to add one to my watch list. Alex, your preferred luxury stock around the world?
I'm certainly not expert on some of the smaller ones, but LVMH always great. That's always a good option to consider. If you're only in South Africa, then Richmond is obviously very defensive orientated and so forth. Or you could go for something completely different, I guess. If we talk about luxury cars, look at something like a Ferrari buy a race. I think that's a great business that's obviously tied to wealth as well. So there are many ways you can look into it.
Yeah, race is the one I pulled up on the screen. I'm never going to own a Ferrari, but I can own a slice of it. Chantal, your preferred or basket of preferred luxuries?
So the best ones by far are Ferrari and Hermes, right? But they're always expensive. So you need to pick your level. So perhaps two really good stocks to add to your watch list. I think if you're a very, very long-term investor, then it doesn't matter at this point in time. You can just buy Ferrari and Hermes. In terms of the other ones that are a little bit more cyclical, I really do like Richemont. It's more defensive than a Louis Vuitton because it's exposed to jewelry, but it's a very well-run, conservatively run business. And then Louis Vuitton, I think from a cyclical perspective, you're probably going to buy in at the right time now. So those four would also be on my watch list.
Question came through. I hold some Redefine. I looked at the results. They looked a little boring. Not that that's a bad thing. I kind of like boring. What are the experts' view on the Redefine numbers? Chantal, they were a little bit boring. And frankly, I don't mind a little bit boring on my Monday morning.
No, we always talk about the most boring stocks on the JSE, and Redefine's probably the most boring REIT on the JSE. But I mean, they've really done a lot in order to kind of steady the ship in a post-COVID-19 environment. I think that you're probably not going to get very exciting growth out of them, but I mean, they do seem to be doing the right things currently. I'd be a happy holder of Redefine, but I'd perhaps look at other REIT exposure as well for something a little bit more exciting. Maybe look at some of the specialist REITs. Not only locally but abroad. I think locally, particularly the self-storage space, I think, is a really interesting diversifier. Supermarket REIT, which looks at UK supermarket properties, is super interesting. PHP, UK healthcare, a really interesting one as well. And then offshore, you have something like you have areas like data center REITs, which I think is just such an exciting area of growth going forward. So yeah, I mean, keep your redefines, but perhaps look for something more exciting to complement those holdings.
Yeah, I don't know. My portfolio is plenty exciting. I like some good old-fashioned boring. Alex, we're out of time, so I want to go straight to stock picks. Lewis is your pick. Trading update today, 55 to 65% up. This is a stock that's on a PE of 7 and a dividend yield of 9. Alex, your pick for today, a cheap as chip stock.
Yeah, certainly. So we're very happy shareholders in Lewis, and I think this update is even better than our very bullish estimates. And I think important to note is that Lewis has been investing materially into the advances book. And this usually takes 2 to 3 years before you start seeing earnings coming through. And I think we're starting to see the evidence of that now coming. The collections remain exceptionally well since COVID years. So you see the bad debts are well controlled. And I think and also look at overall consumer. We think with interest cuts coming down and probably going to pick up a little bit more consumer spending as the year goes on. We think Lewis is very, very well positioned at the moment. And even from this high base of earnings, we think they can further grow earnings, albeit it'll be much lower levels. And after they get the balance sheet a bit more under control, because they're investing a lot of money, they'll probably return back to special dividends and share buybacks, which I've done historically as well. So this is a company that gives money back into the shareholders' pocket and is delivering growth. And if the CEO there, no one knows more about furniture retail than anyone in Switzerland, so we're very happy to back him.
Yeah, stock up 16%. And it's one of my favorite charts that the share is an issue with Lewis, and it just always goes down. Chantal, you're going with Mondi.
Yes. So, I mean, Mondi has been one of those stocks that have been under pressure for the last 5 years. It's kind of oscillated around current levels. At first, there was a lot of negativity around Mondi's exposure to Russia, and then there was also a cyclical downturn in paper and packaging prices. We're now seeing pricing improve. Mondi has exited from Russia, but the share price has done absolutely nothing. So the expectation is that we could see price increases really supporting revenue, and operational leverage in that business is very high. So my expectation is that we'll get really strong profitability coming through over the next few years, and the market hasn't seemed to adjust for any of those positives that have come through from Mondi over the last few weeks.
Yeah, and that share's trading, as you say, as at the levels it was after the Russian invasion of Ukraine back in Feb 2022. We'll leave that there. It's all for Stockwatch today. Thanks to our guests, Alex Duys and Umthombo Wealth, going with Lewis, Chantal, Marx, FNB Wealth and Investments with Mondi. Up next, the close. Stay watching.